Through 10 years of trading the Forex markets, this has to be the fastest way to become profitable. You need to understand support and resistance areas. Focusing only on key support and resistance levels will help you filter out a lot of the noise in between the support and resistance. In return, this will give you profitable trading setups with good risk reward, which simply means you're risking less to gain more. Between the main resistance and support area, there's also something I like to call a mid-range zone, which can be drawn the same way as support and resistance. The only reason I like to call it a mid-range zone is because it's in between the strong area of resistance and support. And using the mid-range zone, you can identify further trading opportunities. Now, to identify clear support and resistance, we ideally want to find areas where the market has bounced off the key level. So in this case, for the support, 1 and 2 would be over here. And clearly we can see a strong resistance zone on the mid-range zone. So 1 and 2 over here. Once we establish a strong supply and demand zone, we can see the market is pushing towards the upside and the downside, respecting the key area of price level. Now, sometimes we're going to have situations where the market actually manages to break our mid-range zone or the key level. In this case, the mid-range zone acted as a resistance just over here, but because of the break, the market pushes towards the upside, respects our strong resistance over here, and the mid-range zone becomes a clear support level. So why is this so important? Well, it's simple. If you didn't have the mid-range zone and considered to enter our trade on the long upper shadow just over here, we aim for a nice risk reward. So we are risking 25 pips to gain 76. And in this case, it would have been a profitable trade. But what you need to remember is what could have happened. So if we get our mid-range zone back, we can see that this was a clear area of sensitivity, and although it was broken and in this case it was successful, it could have been a totally different scenario. What if the market decided to come back towards the upside after the bullish engulfing candlestick, which is a strong candlestick confirmation for further bullish pressure, and it could have definitely just went towards the upside and hit your stop loss. So it's something to think about. Good way to prevent that is just taking some of your profit on the mid-range zone. So in this case, it would have been pretty much a 1-to-1 risk-reward ratio. Move your stop loss to entry in this case. If it goes towards the upside, you're not losing anything. And if it goes towards the downside, you can carry on making a little bit more money. Or you simply could have closed a partial profit and kept the trade running if you knew what's happening next. I'm saying that for a reason, because we're missing something very important. Can you spot what it is? I'll give you 5 seconds. 5, 4, 3, 2, 1. We need a trend. I can see a bearish trend just over here. So if we just connect the dots, the trend started over here. That's the first, that's the second touch, and that's the third touch. I used to call this the 1 to 3 touch pattern. 3 touches is a substantial trend, and usually that's where it bounces off from. So as we can see, once the third touch happened over here, it went towards the downside. So if you knew this, you wouldn't really move your stop loss to entry. You would have closed a partial position over here to secure some profit because there is a mid-range zone, but the stop loss wouldn't be moved because you still have this strong downtrend happening, which will likely protect your gains and continue moving towards the downside. Now, there are 2 ways the candlesticks move in the market: bim bam bim and bim bim boom. Yeah. Now, to give you an example, bim, bam, boom. Why is this important? Completion of exhaustion ends here. We are continuing to push towards the downside. Same thing in the opposite direction. Bim, bim, bam. As we can see, nice pullback just over here has stopped. We find entry candlestick confirmation. We are moving towards the upside to retest our previous area of key level. We can even see the same thing on our trade we discussed. Bim, bam, boom. The bam happened over here. It touched the previous area of trend line that is going towards the downside, and also near the area of strong resistance, right? So this becomes strong confluence, meaning we have 2 candlestick confirmations, which is the resistance and the trend line towards the downside. And if you want to count it, is the candlestick wick just over here. So bim, bim, bam, we are heading towards the downside. Now, with this new understanding, we can finally move on to the next next section, which is a little bit more advanced. This, my friends, is a descending triangle. The important part over here is the market is squeezing. I like to call this a squeeze pattern because every single time the market moves less and less until it has to break. And either it's gonna break towards the downside just over here or the upside just over here. In combination of this descending triangle, I like to use two simple moving averages just to confirm the trend bias and actually see in action how the moving average is reacting with the candlesticks. Every single time the moving average has touched the candlesticks reacted and pushed further down. Now, in combination with our drawn trend, we can definitely see that we should be selling. But where do we sell? Well, there were some potentially nice signs just over here where you could have entered. Nice shooting star. Went towards the downside on all of these three candlestick confirmations. I believe the best trading opportunity is when it actually breaks the descending triangle. So if we have a look just over here, it manages to break towards the downside. And what move happens next? Well, that's right. Bim, bim, bam, right? That's the first bim. What happens? It confirms break of structure. The second is the pullback. The pullback happens where? To the previous area of support and resistance. This was the previous support level just over here. But because it's broken now, it becomes a nice resistance zone. And we also have the 20 moving average, which is the extra confluence we need when finding high probability trades. So you get this trading scenario, you enter this bad boy over here, you want your stop loss just above the previous area zone. So somewhere over here, 50 pips should do. And if you're swing trading, you can do, a nice 160 pips. Adjust for the time frame you need, but the concept stays the same. So let's see what happens. It goes towards the downside and continues on. Personally, I'm a little greedy. I enter when it just pulls back towards the two moving averages just to get the tiny bit of better entry. But typically, you want to wait for a candlestick confirmation such as that bearish engulfing candlestick, meaning the bullish candlestick over here is definitely swallowed by the next bearish candlestick, which does confirm a lot of bearish pressure, which we can definitely see. Bim, bim, bam, again moving down. And the trading opportunities doesn't have to end over here. You can open another trade on another area zone. So let's remove our take profit and put another nice little support and nice little trend over here. What do we have? Another descending triangle. Clear support level. Squeeze is happening at the moment. What's likely to happen? Yes, a nice push towards the downside. So why does this work so well? The first is the push towards the downside. The second is the exhaustion back towards the upside to the previous area of moving averages, and in this case the resistance. And the second is the continuation of the trend, which goes towards the downside. So in this case, you could have pulled off two descending triangle trades without a problem. Now let's take a look at the opposite, which is the ascending triangle. But this time we're going to discuss the best way to enter and exit your trade for maximum profit. Now, some traders could enter after a couple of touches of the trend. This is our first and second touch. On the third touch, you could potentially enter the trade long, and it would have been a quite profitable one. However, personally, I wouldn't be trading it because it's too risky. And can you tell me why? Again, I'm giving you 5 seconds. 5, 4, 3, 2, 1. There's a lot of moving averages in our way. So if we enter the trade somewhere over here and it's pulling back towards the upside, yes, you could have potentially closed off some of your positions on the moving averages, which is possible. However, this wouldn't really give you the perfect risk reward. What we want to do is wait for that squeeze to break towards the upside and then enter. So let's just see what happens. Goes towards the upside, pulls back, and should be heading towards the upside. Now, what did we learn previously? That's right, it's bim bam boom time. Where do we enter our trade? The previous area of pullback, which is over here. So again, market pushes up, breaks our previous area of resistance, the resistance now becomes support level over here. The candlesticks reach this area level and continue with the trend towards the upside. This will immediately give you a great risk to reward ratio. We are only risking around 13 pips to get 34.3 pips. That's a risk to reward ratio of 2.66, which if successful will cover some of your losses that you will eventually have. So why is entering over here so much better than entering off a trend? Well, for one thing, I have 4 moving averages opened, which is 20, 50, 100 and 200, and all of them are below the candlesticks. Moving averages heavily react with the candlesticks, especially on a trend. It's a dynamic support and resistance. Once the candlesticks touch the moving averages, they usually react and make the candlesticks go towards the upside. So you always want to cover your moving averages with your stop loss. Now there's another question we haven't answered. Where do we take our profit? Or where do we actually aim? Well, if we quickly scroll to the left, we can see that the previous area zone of resistance was over here. Some people could be aiming in around this area zone because previously there were 2 touches that were reacted, but personally I wouldn't because I'm greedy and I want more profit. And also there is something called a psychological level. Now this area of resistance is actually sitting on an important level, and it is the 0.96000. Why is this important? And why is this called a psychological level? Well, most of the market makers and even retail traders like round numbers. Once these round levels are reached, most traders take some of their profits. What happens when people take their profits? They are no longer in the trade and the market is no longer buying because they believe that this round level is too expensive. And when the price is too expensive, sellers will come in the market because in Forex you can buy and sell. So if you had marked this area zone, you would know that a lot of selling pressure is over here and likely is going to push towards the downside. So let's just see what actually happened. So it continues moving up, reaches our take profit level just barely by a small wick, and we can actually see how important the 96000 level was. Straight away, a lot of sellers came through the market, and even though we had the moving averages and the trend with us, it did not matter. The round key level was too strong. So I believe this is the fastest way to become profitable because from personal experience, I had a lot of success trading this strategy. However, we are still missing one key point to this crucial strategy, and that is multiple time frame analysis. So this is the 4-hour time frame, and the main thing you want to look at is where the moving averages are at. Typically 20 and 50 are going to be your go-to moving averages to look at. If I just move this take profit box slightly, we can see our breakout candlestick is also over here. So what I recommend is trading in multiple time frames in the same direction. So since the previous time frame was only the hourly, and since this is the 4-hour time frame, it will have much more important price action. And we can see that the 9.6000 level over here has reacted nicely. We can barely even see that previous area level I talked about, just some wicks, doesn't really matter. So using multiple time frames is crucial to your trading success because it's going to give you a slightly different story on each time frame, which then you will combine and make an educated guess that likely, in this case, the market will go up and bounce off the psychological level, which it did. Now, if you really want to improve your trading, I recommend watching my candlestick course. It's free and there's a lot of value in that video, or you can join my Forex Signals group in the link down in the description below as well. We are absolutely dominating the market. And for now, take care, have a nice day, and bye.